Hello everyone, and welcome back to the channel. Gold has always been seen as the ultimate safe haven asset. For centuries, investors have turned to gold in times of uncertainty, inflation, and economic instability. But recently, something surprising has been happening. Some of the so-called smart money, institutional investors, hedge funds, and large financial players, appear to be reducing their exposure to gold. So the big question is, why is smart money dumping gold? And more importantly, should you be worried? Let's break it down. First, we need to understand what smart money actually means. This term usually refers to experienced investors with access to better information, advanced tools, and large amounts of capital. These are the players who often move markets before the average investor even notices. And when they start selling, it usually signals that something bigger is happening behind the scenes. Now, one of the main reasons smart money may be stepping away from gold is rising interest rates. Gold doesn't pay interest or dividends. It just sits there. So when central banks increase interest rates, other assets like bonds or savings accounts start offering better returns. This creates what's called an opportunity cost. Investors begin asking themselves, why hold gold if I can earn a steady return somewhere else? As a result, money starts flowing out of gold and into interest-bearing assets. The second reason is the strength of the US dollar. Gold and the dollar usually have an inverse relationship. When the dollar gets stronger, gold tends to fall. Why? Because gold is priced in dollars globally, so when the dollar rises, gold becomes more expensive for foreign investors, reducing demand. If smart money expects the dollar to remain strong, they may reduce their gold positions ahead of time. Another key factor is market sentiment shifting toward risk-on assets. When the economy looks stable or optimistic, investors move toward assets like stocks, technology, or even cryptocurrencies. These are considered risk assets because they offer higher potential returns. Gold, on the other hand, is seen as defensive. So when confidence returns to the market, gold often loses attention. This doesn't mean gold is bad, it just means it's not the top priority in that moment. Now here's something most people don't think about: profit-taking. Smart money doesn't just buy and hold forever. They take profits. Gold has had strong runs over the past years. So some large investors may simply be locking in gains. This doesn't necessarily mean they've lost faith in gold, it just means they're managing their positions wisely. Another interesting angle is diversification into other assets. Some institutions are shifting part of their portfolios into silver, commodities, energy, even digital assets. This doesn't mean gold is finished, it just means it's no longer the only safe haven in the game. But here's where things get really important: just because smart money is selling doesn't automatically mean you should panic. In fact, history shows that gold often moves in cycles. There are periods where gold underperforms, and then suddenly, it comes back stronger than ever, especially during crises, inflation spikes, or financial instability. So instead of blindly following smart money, the better question is, what is your strategy? Are you holding gold as a long-term store of value? Or are you trying to trade short-term price movements? Because those are two completely different approaches. If your goal is long-term protection against inflation and economic uncertainty, short-term selling by big players may not matter much. But if you're trading short-term trends, then yes, smart money movements can be a strong signal. Now let's address the biggest misconception: smart money is always right. Not necessarily. Even large institutions get things wrong. Markets are unpredictable, and no one has a perfect track record. Sometimes, what looks like smart money selling is just repositioning, not a full exit. And sometimes, retail investors who stay patient actually win in the long run. So here's the bottom line: smart money may be reducing gold exposure right now due to rising interest rates, a stronger dollar, better opportunities in other assets, profit-taking after gains, portfolio diversification. But that doesn't mean gold is finished. It just means the market is shifting, as it always does. The real question isn't what smart money is doing, it's whether you understand why they're doing it, and how it fits into your own strategy. Because in the end, successful investing isn't about following the crowd. It's about thinking ahead. And sometimes, the biggest opportunities appear exactly when others start to lose interest. So stay informed, stay patient, and most importantly, stay strategic. If you found this breakdown helpful, don't forget to like, subscribe, and hit the notification bell for more updates on gold, silver, and other investment insights.